everyone. Welcome to MSS Mentorship and Online Classes. I am Mohamed Sheikh Sisi, your tutor and your mentor. Today, we are going to complete IFRS 9 financial instruments. We are going to look at the derecognition of financial instruments, the removal of financial assets or financial liability in the financial statement. Also, we are going to look at the concept of factoring. How are we going to factor, or how are we going to sell out our receivable balance to an other party who is the factor? Then how are we going to account for it, whether the risk and reward has been transferred to the factor or not? So basically, we are going to look at the concept of factoring of receivable, which is very much important. And finally, we are going to look at the disclosure requirement of IFRS 9. Very important concept to know. So basically, when we are talking about the derecognition, it means removal of financial assets or financial liability in the financial statement. So financial instruments should be derecognized as follows. Financial assets, first condition, when and only when the contractual right to receive cash flow from the financial asset expired. For example, there is a financial asset, then the company has received 100% of the interest income as well as the cash payment, then it means for the stipulated period as per the contract agreement, then automatically there is time for that particular company to derecognize, to remove the financial assets within the financial statement. So when an option held by an entity has expired and become worthless, or when the financial asset has been sold and the transfer qualifies for derecognition between substantially all the risks and reward of ownership have been transferred from the seller to the buyer. So basically, what they are saying is that when there is a limitation or when there is a transfer of risks and reward to another party, then it means we need to derecognize that particular financial asset. Going back to the definition of an asset, there should be the controllability aspect of the asset. It should be controlled. Then it should result to economic benefits. Then it should be as a result of past events. If the aspect of controllability is lost, then it means we are not going to continue the recognition of that particular asset in the financial statement. We need to derecognize the asset from the financial statement. Or if the asset cannot provide a future economic benefit to that particular business, then the business is going to derecognize. It's going to remove the asset from the financial statement. So basically, when the definition and the recognition criteria of an asset, you know, is not met, then automatically we need to derecognize the assets at that particular point in time, whether it's due to loss of control or there is a transfer of risks and reward to another party, or as a result of disposal, whichever the case might be. If there is a loss of control, or if the future economic benefits is not certain, or the business cannot, don't have the rights to receive the cash flow from that particular asset, or the rights to receive the cash flow has expired, in whatever case, we need to derecognize that particular asset from the financial statement. So derecognition is talking about the removal of assets from the financial statement or the removal of liability from financial statement. So now we are talking about financial liability when and only when the obligations specified in the contract is discharged or cancelled or expired. So now if we're talking about liability, there should be a present obligation. So if the obligation has been executed, or if the obligation is cancelled, or if the obligation is expired, automatically there is no existence of present obligation at any point in time. So if that is the case, we are going to derecognize that financial liability. We are going to derecognize the liability. So what you need to know relating to the derecognition, you need to know the definition and the recognition criteria. If you know the definition of asset, of financial asset and financial liability, then if you know the recognition criteria, then if the recognition criteria is not met, then we are going to derecognize that particular asset. Or if the financial asset or financial liability has expired, where the contractual right to receive cash has fully been expired, or the present obligation to discharge or to make payment has been expired or cancelled, that particular transaction should be removed, should be derecognized from the financial statement. So basically, this is the concept. On the recognition, the difference between the carrying amount of the asset or the liability and the amount received or paid for it should be included in the profit or loss for that particular year. So whether it's a gain, we are going to recognize it, or whether there's a loss, we are going to recognize it. It's clear because at that particular point in time, all gain or losses can be crystallized, can be recognized into the financial statement, period. So for the recognition, this is what exactly you need to know. Nothing difficult about the recognition. So basically, we are going to look at the critical aspect of this lecture today, which is the factoring of receivables. So when we are talking about receivables, it means if you have a business, then it's obviously that you are going to sell on credit to your customers. So at a particular point in time, the customer will have a payment period. Let's assume it's 6 months time or 3 months, whichever the period might be. So at the end of the year, all outstanding customers balances is what we refer to as the receivables. So now if we're talking about factoring of receivables, it means we as a company is going to transfer the responsibility, is going to transfer the risk and reward of managing the receivable to another company. So the point of transferring the receivable balances from the company ownership, from the company management to the factor or to another party is what we refer to as the factoring of receivable. It means we are going to transfer our receivable balances. For example, the company has 10 customers, each has to pay the company, let's say $5,000. So cumulatively, the receivable balance will be $50,000. So if that is the case, the company will decide to transfer the risk and reward to the factor. When I'm talking about the factor, this is the person that will receive, that will accept the receivable balances. So it can be a secure loan or it can be not a secure loan, but we are going to look at it. So basically, what you need to know about the factoring of receivable is that if a company transfer its receivable balance to another company, which is the factor for management and collection, and it receives an advance on the value of those receivables in return. So basically, this is the concept because when you're going to transfer your receivable balance, you're going to receive some amount, you know, in return for the transfer of your receivable balance and also the management and collection process of the receivable balance. So now what you need to know for the examination, which is very key. Key is the seller in substance receiving the loan or the security of the receivables? First question. Or are the receipts an actual sales of those receivable balances? So what you need to know, you need to ask yourself a question. Now, I'm going to transfer my receivable balance to the factor. Why I am going to transfer the receivable balance is for me to secure cash from the factor. For example, I'm going to use the receivable balance as collateral to secure a loan. For example, the $50,000, I'm going to tell the factor that you can give me $20,000 for now, then you can hang on to the receivable balance. You can hold the receivable balance, until I'm going to repay you that particular amount plus the interest, whichever the condition might be. So in that situation, it means yet still, regardless of the transfer of the receivable balance, the risk and reward is still with the company. If the receivable did not pay their balances, the company will have to recognize the provision, the bad debt, and it will make provision for bad debt. So the expenses that we are going to recognize as bad debt, the provision that we are going to make will still base with the company that owns the receivable. So if that is the case, it means the amount we are going to receive from the factor is we are going to treat it as a loan that will be secured against the receivable balance. Very important concept. If the risk and reward, if there is any bad debt, the company will suffer that bad debt. If there's any provision, whether it's increase or decrease in provision, the company will suffer that particular. It means regardless of the transfer of its receivable balances to the factor, yet still the risk is still with the company. So automatically in this situation, we are going to account for it as a loan. Or are the receipt as actual sales of those receivable balance? It is possible that within the arrangement, we made it clear that the $15,000 worth of receivable balance, you're going to manage it and you're going to collect it. If there's any default, it will be the responsibility of the factor. If any receivable did not pay their balances, the bad debt will be at the expense of the factor, not the company anymore. So if that is the case, then we are not going to account for it as a loan because it is not secure against the receivable balance. We did not use the receivable balance as collateral in this particular situation because the risk and reward has been 100% transferred to the factor. So if that is the case, then we are going to account for it separately. Very important concept you need to know. We need to consider who bears the risk of losses, either through slow payment or irrecoverable, which is clear. A sales of receivables with recourse means that the factor can return any unpaid. Very important concept. We're talking about recourse. Um, Now let's understand the concept. A sale of receivable with recourse means that the factor can return any unpaid debt to the business. If that is the case, it means the business retains the risk of irrecoverable debt. In this situation, the transaction is treated as a loan secured against the receivables rather than a sale. Very simple. It means the risk and reward is still with the company because the company will, the factor can return any unpaid debt back to the business. So it means if there's any recoverable debt, the business can bear the risks. If there is any slow payment, the business can bear the risks of slow cash flow, not the factor. So automatically, we are going to account for it as a secure loan, which we are going to use a different concept of under IFRS 9 to account for it. A sales of receivable without recourse means, let me underline, with recourse. Without recourse. The sales of receivable without recourse means the factor bears the risks of irrecoverable debt. The factors bear the risks of irrecoverable debt. In this case, this is usually treated as sales, and the receivable are removed from the entity financial statement. Very simple. If the risks and rewards is transferred to the factor, then it means we are going to account for this as a sales. Then we are going to derecognize. We are going to remove the receivable balance from the financial statement. So this is what you need to know for the examination. For strategic business reporting students, we are going to look at some few calculations to see how best you can able to calculate the portion of the recourse as well as with recourse as well as without recourse. So let's look at further explanation of the factoring of receivables. In most form of factoring, receivable balances are sold to the factor, but the later degree of control and responsibility for those debts will vary from one arrangement to another. It depends. A significant accounting question is only likely to arise where the factoring arrangement leads to the receipt of cash earlier than will have been the case had the receivable been unfactored. If this is so, the question to be answered is whether the seller has in substance received either a loan on security of the receivables or has actually sold the receivable. So basically, they are just elaborating on the similar concept I've just explained. So what you need to know, which is very key for the examination, you need to know if the risk and reward has been transferred to the factor. The indication of risk and reward, it means the company has no risks relating to bad debt anymore or any slow payments. If the company has risks relating to any bad debt or slow payment, then it means that particular transaction should be treated as a loan, should be treated as a financial liability. Other than that, we are going to account for it as a sales, and we are going to derecognize the receivable balance within the financial statement. Very simple and very easy to understand. So basically, we are going to look at example, which is very important for us to know. The example we are going to look at, um, an entity. Let me look at the requirement first. How this arrangement be accounted for in the financial statement of the year ended 31st September 2007. So it's very simple. I'm not going to spend much time, just going to browse through it, because when we are going to get our live online session, we are going to solve all of these example questions. I'm encouraging everyone to be part of my live session, because you will have the opportunity to ask questions, you have the opportunity to interact with other students, and you will have the opportunity to have one-on-one discussion with me as well. So basically, because of that, I'm not going to solve this as well. But what you need to know, look at the question, very key. The an entity has an outstanding receivable balance with major customer of $12 million, and this was factored to finance. Who is the factor? On 1st September 2007. In terms of factoring, we are finance co will pay 80% of the gross receivable outstanding balance. So 80% will be received by the company, and they are going to issue a collateral, which is the receivable balance, to the entity immediately. The balance will be paid less the charges below. When the debt is collected in full, any amount of the debt outstanding after 4 months will be transferred back to the entity, which is clear. So if there is a risk, if the debt will be transferred back to the company, it means the risk and reward is still with the company. The risk of bad debt is still with the company. So this is an indication of um, this factoring to be treated as a financial liability. Finance co will charge 1% per month, which is fine. Don't worry about that. This is how we are going to calculate the components that the factor will benefit from. The finance co will charge 1% per month of the net amount owing from the entity and beginning of each month. Finance co had not collected any of the factor receivable amount by the end of the year. Wow. The entity debited the cash from, so don't worry about it. So basically, this is just to board in the concept that this is what you are going to expect in the examination. So when we are going to look at the live online session, we are going to cover this particular example. So now finally, we are going to browse through the disclosure of financial instruments. And the disclosure is covered according to IFRS 7. Yes, provision provide the disclosure requirement for financial instruments. The major elements of disclosure required are: carrying amount of each class of financial instrument should be recorded either on the face of the statement of financial position or within the notes. So when you're talking about disclosure, it means we are going to look at how are we going to disclose the figures in the financial statement. When you're talking about financial statement, we are looking at the income statement, statement of financial position, cash flow statement, equity, notes to account. So in whichever area you're going to disclose, you're going to show this particular financial instrument transaction, you need to ensure that the disclosure is properly cleared, so that everyone can able to understand the transaction. So now the option is you can either recognize it in the statement of financial position or you disclose it in the notes to account. Items of income and expenses, gains or loss for each classes of financial instruments, either in the statement of profit or loss and other comprehensive or within the notes to account. Very simple. From financial assets through P&L, you are going to account for it under the statement of profit or loss. Through other comprehensive income, you are going to account for it under comprehensive income. Amortized cost depend to the two tests, the cash flow test and the business model test. This must cover the entity exposure to risks, management, objective, and policy for making those risks and any changes in the year. So basically, what you need to know about disclosure, you need to show every bit and pieces of transaction within the financial statement. You can give a summary, for example, talking about the income statement, you can show um, income from or expenses relating to X, Y, and Z, or we can say gain from the fair value by the profit or loss or the other comprehensive income. If that is the case, You can put a single figure, but when you are going to the notes to account, you can explain in detail. You can show the breakdown of expenses. You can show the breakdown of losses. You can show the breakdown of revenue. Whichever breakdown that is required, you can show it under the notes to account. The notes to account will give us a clear and a more clarified information about the single figures in the financial statement. Also, when we are going to look at the live online session, we are going to solve the comprehensive example. This contains a lot of concepts that you need to know. Note 1, we are talking about land and building. Note 2, we are talking about note 3, 6% loan note. We are talking about note 4, which we are going to look at the compound financial instrument. And we are going to talk about note 5, which we are going to account for it. So basically, during my live online session, we are going to cover these two examples. And also, we are going to look at more objective test questions. So thank you very much for your time. We are going to stop here, and I have completed the concept of IFRS 9. Thank you very much.